Well, hello and welcome. You're watching Closing Trades here on ET Now. I'm Harsh Saita, with me is Nisha, and we'll take you through the next hour and a half of trade. Today, let's pull up the Nifty, and of course, it's not the best day per se where the Nifty is concerned. It's been a difficult day. We've slipped a little bit further on the Nifty 50 benchmark, 0.6% lower. Let's talk about some stocks which have increasingly come under pressure, at least over the last hour or so of trade. And within that basket, you have Cipla, Hindustan Unilever, Kotak Bank. Some of those stocks don't change from the morning. They've largely been the same. Even a Colgate Palmolive, I'm sure, is reeling under some bit of pressure after those weak set of numbers that were disclosed post-market yesterday. So still down 3% on a Colgate Palmolive even now. Max Health also down around 2%, so is an Ultratech Cement. You also have names like both of the Adani twins, which are down 2% in trade. So you're seeing some bit of pressure mounting on those names. What's standing out though, it's the metals pack. Hindalco is up 4% and leading the rally on the Nifty Metal Index. Let's pull up some of the others, a Tata Steel, a JSW Steel, among others, also doing fairly okay. Vedanta is up 3% as well in trade. So you're seeing some bit of traction, and Nalco is up 4%. Tata Steel absolutely flat. In fact, it's given up all of those gains. I stand corrected, and so is a JSW Steel, absolutely flat. But some of the broader market names, Nalco, Hindalco and the likes, which are doing relatively better in trade. What's also doing okay is something like a Bharti Airtel, a Nestle, surprisingly, despite FMCG not doing too well. Nestle is holding up very, very smartly. You've also got within the sectoral index, the Nifty Metal in particular up 1%. The Nifty Realty is flat. The oil and gas index also getting some support from ONGC is up about 0.1% thereabouts, so absolutely flat. But outside of that, pressure building up on the FMCG index, on the IT index. The auto index too is down 0.6 odd percent. So is the Nifty Bank. The Nifty Bank is down 1% now in trade. So you're seeing clear and evident pressure mounting on the Nifty Bank. And typically when banks and IT aren't doing well, it's tough to expect the Nifty 50 to do well. You've got PNB, Kotak, HDFC Bank, all of them down 1.5% plus in trade. So you're seeing pressure on all of those names. But Snehi, broader markets, talk to us about what they're doing.
So the mid-cap index is down 0.4%. Small cap is doing slightly better compared to where the benchmarks are. In the red nonetheless, but the cuts are lesser than what is happening on the Nifty. Some stocks that are in focus from the broader end of the market, Thyrocare, that stock is up 1.5% after promoter Docon Technologies has sold 53.3 lakh shares in the open market, and this has happened at a price of 667.7 crore rupees. So Thyrocare looking good, up 1.5%. Very recently, we have numbers coming in from Aditya Birla Sun Life, AMC, their Q2 numbers. Net profit is up about 1.5% on a year-on-year basis. Revenue also up about 10% on a year-on-year basis. So let's see what AB Sun Life, AMC, is doing. If we can just pull up that stock and see what the impact of the second quarter earnings has been on that stock. We'll get that stock for you in a bit. Other than that, you have a news coming in from PVR Inox, wherein they've opened 3-screen multiplex in Sikkim. So that is a positive coming in for them as well. Cyan DLF, you have a new CFO appointment with effect from today. Mr. R.M. Subramanian is the new CFO for Cyan DLM. So that stock also in focus. And Hyundai Motor India, they're going to be launching a compact SUV. This is also positive for the company, and that stock is in focus as well. But well, a little bit of cut coming in, 1.3% lower on Hyundai Motor. But let's take it across to my colleague Ashesha to understand why the entire metal pack, and even particularly within metals, it's the aluminum stocks that are doing very well. Ashesha, what's the reason behind this?
Well, yes, aluminium stocks are soaring in trade today. Hindalco, as you rightly mentioned, the stock is up 4%, the biggest gainer on the Nifty 50 index. Nalco and Vedanta are also gaining anywhere between 2 to 4 odd percent in trade today. One of the main reasons is the surge in aluminium prices in the global market. Remember, aluminium prices on London Metal Exchange have now crossed that $2,850 per ton mark, and we have seen an uptick of nearly 2% in trade yesterday, and aluminium prices are up 6.5% this month so far. So that's the kind of up move that we have seen in global aluminium prices. And one of the main reasons of the surge in aluminium prices is on account of supply crunch, And there are two factors. One, supply crunch in aluminium market as far as Europe is concerned, and in Iceland as well. One of the three smelters has been shut for operations, because of which we are seeing this supply glut. So yes, on account of supply crunch, aluminium prices on the global metal exchange are rising. Now, apart from that, remember Alcoa reported its numbers yesterday post-market hours. The stock shot up nearly 12%. Perhaps some kind of rub-off effect is what we are seeing on Indian Metal Exchange and the Indian aluminium stocks as well. One, it reported better than expected set of numbers, and second, the management commentary that came in after Alcoa's results was also very positive. They say that the surge in aluminium prices, supported by the rise in premium, fully offset the negative implications of tariff. So the management commentary was very positive. So one, on account of surge in aluminium prices, and second, on account of 12% spike that we saw in Alcoa, all of these aluminium stocks are buzzing in trade today.
Aluminium, a buzz. Thank you for that, Ashesha. And Kunal, what do you make of some of these names on charts? Hindalco and Alco, all of those stocks doing really well, and the metal rally continuing on a day like this.
Yeah. So I think they're looking very attractive now, also at current levels. But there's a clear demarcation of leader stocks in the metal pack. So I think Hindalco is one of the better performers. Vedanta has been a surprise mover, frankly, because I expected the stock to be a little bit behind, with respect to the other peers. The only surprise which you're seeing is that the likes of JSW Steel and Tata Steel, they're seeing some muted price action today. But netted, this tells you that the markets are still very eager with the kind of metal price action. What we've seen, it's apparently one of the top two sectors which have been doing pretty well for itself from the 24,500 levels on the index when this move started off for the benchmark indices. So I think in that context, the rally still continues to persist and maintain on the upside for the metal counters. Hindalco, Tata Steel are the two counters which have been bullish on and continue to be bullish on for these stocks even from current levels.
Okay, that's the take coming in on some of the metal constituents. But Kunal, how sustainable is this rally that we're seeing in metals? Because if I can point out a very interesting trend to you, something I've noticed. 3 days ago, FMCG top sectoral gainer became the loser next day. Yesterday, IT top sectoral gainer, loser again today. And today, metals. Could this repeat for metals too?
Yeah, this generally happens. It's a sector rotation which is at play. So whether if you look at this on a daily basis, then yes, you might probably have that churn. And the markets have not been linear also in this last 2,000 points kind of a rally. So I think you have to give it to the market also that in that context, you might have one odd sectors which performs exaggeratedly very high on one day, cools off the next couple of days. But then if in the context of a 1,500 point rally, if you see the sectors performing by a 5, 10, 15% margin, that's a very good trend for, setup for these sectors. That I believe is what's exactly happening for many of the sectors. Like, we were discussing real estate pack over the last, a couple of days or start of this week. The real estate rally has picked up good pace. You've seen many of the real estate counters now heading towards breakouts of their previous swing highs. So that's another sector to look out for. That I believe is a sign of a key trend. One-off days, these stocks moving up higher and then cooling off the other day. That's a natural way of the markets going to a sector rotation.
Okay, Kunal, picks in this market?
So I'll still concentrate on the buy side over here, even though the indices are a little bit on the downside, because now the risk reward would be favorable. So the first one is about Bajaj Auto. This is more of a contrarian buy. At current levels, the stock is down 0.5% or so broadly. I think at 9,040 odd levels, 40-50 levels for Bajaj Auto, would look out for 90-50 as a target. Stop loss at 89.50. And the second would be about PNB Housing. This is a classic breakout candidate. The stock has broken past about the 900 mark. The next barrier or the resistance for the stock is closer to the 925, 930 range. So keeping that as a target and would suggest a stop loss of 890 for PNB Housing.
Okay, so those are the top picks for the day from Kunal. But what we'll do is we'll slip into a very short break.
Back with closing trades and the market continues to be subdued. Looks like we might not be ending in the green for the week. But let's take that conversation ahead with Mr. Venkatesh Balasubramaniam, the MD and co-head of research at JM Financial Institutional Securities, joining us on the show. And hi, sir. Thank you for your time today. Give us a sense of where you have, of what your reading rather is on the way the market has been reacting over the last couple of months, especially since we've seen a little bit of recovery, if you could call it that, from the kind of consolidation that we've been seeing over the last 6 to 8 months. But once again, anything that we're seeing is not sticking in terms of the gains we're seeing. Your take on that, and where do you think overall the market could head from here?
Okay. Firstly, good afternoon. Thank you for having me on your show. Now, on the markets, see, one cannot run away from from the fact that the markets are expensive. The market is trading almost at 23 or 24 times 1 year forward, which is on the expensive side. It is almost like one standard deviation away from the mean. Now, given this context, you could possibly justify these valuations if the market was giving you 15% or 20% kind of EPS growth. We started the last year, which is FY25, with an EPS growth expectation of almost 15%. We ended up with something like 3.4% kind of growth. Now, in the current year also, we started with almost 15% kind of growth expectations. Currently, that has got chopped down to roughly around 7%. Given this context, it is very hard to expect more than modest or flattish returns for the current year. I think even for the last 12 months, the market has not given any kind of returns. So we personally believe that there isn't too much of money to be made, at least in the headline indices, because all of them are very expensive. There might be individual stocks here and there where you could be making returns. But yes, it is a fact that the market is on the expensive side, and probabilistically it is very difficult to make returns in this kind of a market.
Mr. Subramanian, hi, this is Harsha. Uh, let me get a sense. So are you not penciling in an earnings re-rating maybe over the next few quarters? Your thesis seems to suggest that it's going to be a slower revival of growth. Is that what you're suggesting or penciling in?
Yeah, precisely. That is what we are trying to communicate here. Let me take an example of banks, for example. I mean, I think in the first quarter, banks' core operating profit actually declined YOY. In the second quarter, again, core operating profit for banks are going to decline in the second quarter also. But yes, banks have given slightly better results than what most people expected. Earnings have got revised up. Similarly, third quarter again, while on a quarter-on-quarter basis, the EPS growth will be maybe a little less of a decline, and fourth quarter you will see an improvement. But these are already factored in the numbers. I mean, it's not like numbers for the index as a whole are getting revised up. And please remember, banks are almost 30% of the index. So unless the needle swings on banks, it is very difficult to have meaningful EPS growth, double digit kind of EPS growth, which is definitely possible next year. But this year it is highly unlikely.
Okay, and therefore, if the earnings revival doesn't come, you will likely not see returns also correspondingly on the index. That's basically your thesis. I get your point, sir.
Yes, yes.
Also, therefore, give me a sense. Where is it? Which are the pockets where you feel that the market is overheated or has run away ahead of itself? Where is the largest risk at this point, in your opinion?
To some extent, I think, for example, pharma looks expensive to us. Also, beyond pharma, I think even, let's say, NBFCs look very expensive. While NBFCs have delivered very decent numbers, I don't think we have too much valuation comfort in these two sectors. Coming to pharma and NBFCs, these are two sectors where they have run up a little too much.
Your take on some of those sectors, but Mr. Balasubramaniam, on the other side, which would be some of the sectors that are complete avoids right now, either on the back of valuations or earnings have been lagging? Anything that you would avoid at the moment?
Yeah, I wouldn't say avoid, but I'll highlight to you the sectors which we are underweight. Like I told you, we are underweight on pharma, we are underweight on infrastructure, we are underweight on defense. We are more or less neutral on metals. We are not positive on metals. And besides this, I think these would be infrastructure, industrial, sports, defense, power utilities. These would be all our underweights in the broader Nifty.
Fair point. Venkatesh, now there's one end of the market which could get impacted if oil prices at all flutter around, and there's plenty of hypothesis which is playing out here because you've got a couple of companies in Russia which the US has sanctioned to some extent, and you could see further sanctions also come through, as a result of which we've already seen a bit of a spike on oil prices. Nothing material yet, but if that were to play out, a very, very real risk for OMCs and that basket, if at all any? And would you then thereafter be tempted to play something like an ONGC of sorts? Is that maybe the one way to play it?
Okay. Now, interestingly, I think what I believe has happened is on Wednesday, the United States of America has put sanctions on some of the Russian oil companies like Lukoil and Rosneft. Uh, and anyone who gets oil from them, you could potentially see secondary sanctions. So what we understand at this point is Indian refiners are scrambling now to kind of find fresh oil contracts if they have to cut back on Russian oil. Now, I believe that even crude prices have gone up by roughly around $5 per barrel. So clearly a risk for the oil marketing companies, like you mentioned. I think it at the margin it will have a negative impact on somebody like Reliance Industries also. But yes, on the flip side, it does benefit somebody like Oil India and ONGC. And between Oil India and ONGC, we have a preference for Oil India. So if you can build a credible thesis that oil prices will go up from here meaningfully, definitely Oil India and ONGC come into play.
That's your take when it comes to this entire oil issue that we're seeing panning out right now. But Mr. Balasubramaniam, let's refocus once again to domestics and talk about earnings. And particularly, let's talk about IT, the large cap IT earnings that we've seen so far. They've not been all that bad, as much as the street was penciling in. Do you believe that there is now renewed optimism in this sector? And do you believe that this little bit of positivity that we're seeing is here to stay?
See, when it comes to IT sector, what we have noticed is all the numbers have been slightly ahead of expectations. Now, but we would like to warn people that don't get overexcited by this, because what you see, large cap IT stocks have gone up by almost 5% on the back of that, and mid cap IT has run up by almost 10 to 15%. So, which basically means that whatever positives came to the results have already got priced in. Now, when I look at large cap IT sector as a basket, it is very difficult to imagine large cap IT growing at more than 5%. And why is that? Because of the deflationary impact of AI. So it will be very hard for IT sector, at least large cap IT, to grow meaningfully. There will be a few exceptions to the rule. For example, in mid cap IT, somebody like Coforge might grow at 15 to 20%. So that might grow faster, but large cap IT, very difficult to see them growing at more than 5%. Now, look at it this way. Nifty trading at 22, 23, 24 times, expected to give you 7% kind of EPS growth. IT sector trading at maybe between 20 to 21, 22 times, it's going to give you 5% EPS growth. I would say that you should be neutral the sector, not get too excited when it comes to IT. There are also some risks on the horizon, which is not priced in, or which at this point in time we don't expect that will play out, which is, for example, the Hire Act, that any kind of outsourcing could actually end up having duties. It doesn't seem logical at this point in time, but at least when it comes to Trump tariffs over the last 6 months, nothing which has panned out seem logical. So I would logically tell you that be prepared for the illogical things happening in this market when it comes to tariffs. So you can't assume that, I mean, 1 week we hear that India and US are going to are reaching an understanding and the tariff problem will be solved. We'll go from 50% to 50% tariff to 15% tariff. The next week we hear news that the tariff talks are not going well. So you're not too really sure what exactly is happening. In this context, we would suggest focus on domestic plays, focus on domestic consumption. Domestic consumption is doing phenomenally well. Don't ignore auto. The run up in auto numbers getting upgraded have just started.
So what? Okay, domestic consumption and auto is what you seem to be liking, Venkatesh.
Yeah.
Okay, and so let's talk about auto. The run up has been stupendous, right? You've had a fabulous last couple of months, especially from the middle of August. What is the basket which you feel will outperform at this point? Because pretty much everything you've owned has run up now. So now, you'll have to deliver in terms of earnings and execution. That's where the focus will be, and the companies which do that will likely outperform. So give us a sense as to what that basket will comprise of.
Okay. Coming to the four-wheelers, Maruti is outdoing almost everyone in the market. What our channel checks are suggesting is Maruti is basically facing stockouts when it comes to inventory. So sales is extremely strong. We personally believe this time around the festive season will extend all the way till December. I think there is a booking pipeline of almost 4.25 lakh cars which are there. That is a booking pipeline that they have. Normally, maybe 40-50% of that gets converted, but usually in the festive season, 70 to 80% of the booking pipeline actually gets converted to actual sales. So you're looking at almost 3 to 3.25 lakhs kind of cars getting sold. So phenomenal. This year, definitely Maruti should give you high single digit kind of growth. We are very positive on Maruti. We would suggest investors stay positive on that. The other four-wheeler company which will do well would be basically Mahindra and Mahindra. I think we started the year with 7% kind of tractor volume growth for Mahindra and Mahindra. That got revised up after GST got implemented to 15%. We will be not too surprised if tractor volume growth in the current year is upwards of 20%. Now, when it comes to UVs, slightly more tricky because they are in the middle of their new model launch cycle. So, for example, they've just launched the Bolero and the response is quite good. Now, the next vehicle which they're going to, the new version of the vehicle which they're going to launch is basically the XUV 700. So, you will see numbers meaningfully going up for Mahindra from January onwards. So, in four-wheelers, we would say Maruti and Mahindra are our two top picks. Coming to two-wheelers, the two companies which are basically outperforming the market are basically Hero and TVS. Both of them are gaining market share. Hero, especially on the electric scooter side. So, for Hero, for the current year, we are expecting something like 12 to 13% kind of volume growth. For TVS, we are expecting 15 to 16% kind of volume growth. Again, Hero and TVS would be the two companies I like on the two-wheeler side. If I have to put it in a pecking order kind of a order, I think the best pick would be Maruti, followed by Hero, followed by Mahindra, and followed by TVS. I would insist and I would thumb the table and tell investors that go ahead, buy more auto.
Hospitality, Venkatesh, because that's one pocket which has seen again a tremendous tailwind. So one, we've spoken about auto, of course, and then within the discretionary space, is hospitality something which is on your radar? Is this a multi-year kind of tailwind that you're seeing in terms of consumption?
See, when it comes to, yes, consumption is strong and there has been gross underinvestment when it comes to hotel infrastructure in India. So while demand is growing at 8%, the supply is growing only at 5%. So we remain very positive on hotels. The problem with hotels is everyone is always scared when the new hotels will come online. So I would say that while you are looking at a multi-year opportunity, please keep re-evaluating the stocks and how many new hotels are coming online every 6 months and recalibrate your investments. At this point in time, the two hotel stocks which we really like are basically Leela, which got listed recently. We also like Ventive a lot. These are the two names which we like. Indian Hotels, ITC, these are slightly on the expensive side, so we are not really pushing those companies. So basically Leela and Ventive, these are the two names which we really like.
In fact, we actually do have numbers coming in from ITC Hotels, wherein the consolidated revenue has seen an uptick of 8%. It's come in at 840 crores thereabouts. Consolidated profit, very healthy jump over year of 74% at 133 crores compared to 76 crores. You have EBITDA also that's gone up about 16%. EBITDA margins are looking healthy, about a 200 bips uptick at 29.3% compared to 27.3% on a year-on-year basis. But the stock has been flipping in the red and the green. I mean, we'll see what the reaction is. These numbers are not all that great, but they're not all that bad either. So it's a little bit of a growth coming in their overall numbers. But Mr. Balasubramaniam, coming back to you, I wanted to get your sense on the entire primary market and the exuberance that we've been seeing over there. lots of new paper in the market and some marquee IPOs as well. Anything that looked good to you or anything that you have newly invested in?
I mean, as the head of research, I can't really invest in
Sure.
some of these IPOs, as you know. But LG Electronics at the IPO price, it was very interesting. But wherever there is an opportunity, it usually gets re-rated very fast. See, the number of IPOs also give you a clear indication that the market is expensive. The number of IPOs, the number of block trades which are happening, promoters are selling, private equity is selling, IPOs are happening. Uh, Clearly, there must be a reason for that, right? That they are all getting to cash out at the right price. So clearly, the market is expensive. I recently remember, maybe a couple of weeks back, when for the first time I saw 3 IPO advertisements back to back on the front page of a business newspaper. I have never seen that in my career before. So clearly, market looks overheated. Promoters are selling, private equity is selling, and also what you're seeing is FII, you are seeing selling in the secondary market. They're obviously subscribing in a lot of these primary issues. But yes, I think this is all getting facilitated by the fact that mutual funds are getting very strong inflows. So they keep the market supported at these levels.
I'll tell you where private equity is actually buying, and private equity in public markets is buying, which is the financials. You seem to be bearish. Talk us through what you believe or why you're apprehensive.
See, it's like this. We've been underweight on financials because, see, it's like this. We thought that after the correction in the market from September till say March, the market's texture will change. Last 10 odd years, India has been basically a growth market. So we thought at least this correction will bring some semblance. People will start looking at value. The only value sector was basically banks, where stocks were, private sector banks were trading at in line with mean, and when it comes to government banks, they were trading one standard deviation below mean. So we actually had a thought process that maybe this was a time for banks because they look very cheap. But we were proven wrong within a space of maybe 2 to 3 months, because we realized that in the India market, at least in the recent past, nothing works other than growth. And you have basically don't have too much EPS growth in the current year when it comes to banks. Now, given that NIMs have bottomed out, and when it comes to loan growth has also been slightly better than expectation, there is a temptation that we are thinking about maybe bringing down our underweight on the sector. But we have taken a call at this point in time. Let's wait for the entire earning season to get over and maybe take a call after November 15th. So let me put it this way. I was a little more negative before the earning season started. I have incrementally become less negative on the banks and financial side.
That is some shred of positivity coming in for the entire banking and financial space. On that note, we'll slip into a very short break. But as we do that, hear out the word coming in from Mr. Vinay Raina, the Chief Commercial Officer at JSW MG Motors. He discussed the momentum of festive sales this year and said that the company has posted strong growth during Diwali. He also highlighted that the company has recorded higher bookings this year. Listen.
I think the core has to be a big thank you to the government for ensuring that they actually looked at automotive as an extremely important part of driving the economy. And the changes that they made in the GST, which they announced well in advance, ensured that we've had a fantastic season this year. We'll have 100% plus growth over last year, and continuing into this month as well, we expect to see a significant growth over a month-on-month period as well. Just in the Dhanteras period, we've had a 50% increase in our deliveries from a year-on-year perspective. So clearly the momentum has shifted positively. And if you look at it purely from a 3-month period, we've consistently been clocking our highest ever numbers month-on-month, and driven right across the portfolio, driven by our Windsor, which is our EV leader, and similarly supported by other cars in the portfolio.
And thanks for staying with us here on Closing Trades on ET Now. But, one sector which has been brought back into focus as a result of that 79,000 crore orders or rather pipeline which has been released by the Defense Acquisition Council. They've approved proposals worth that quantum. And this is for the Army, Navy, as well as the Air Force. What does it mean for India defense, and who are the likely beneficiaries, more importantly, because that's the pocket everyone will have their eye out on. Kanishka is here to tell us more on that.
Well, yes, after nearly 2 months of relative quiet, defense stocks are back in focus, driven by strong procurement momentum from the Defense Acquisition Council. So far in FY26, the Defense Acquisition Council has approved nearly 2.51 lakh crore of procurements. That's up from 2.22 lakh crore in FY25. Now, these include 1.05 lakh crore in July, 67,000 crore in August, and 79,000 crore rupees in October. That's the latest package. Now, according to Alara and Citi, the key proposed procurements will benefit several companies. For the Indian Army, the Nag missile Mk2, that is likely going to benefit Bharat Dynamics with an estimated size of about 2,000 crore rupees. GBMES will aid Bharat Electronics, BEL, and Astra Microwave as well. And high mobility vehicles, they are likely to support BEML's orders. Now, for the Indian Navy, if you look at it, landing platform docks, that is LPD, that will likely benefit the likes of Mazgaon Dock, Cochin Shipyard, L&T, and GRSC, with an estimated size of nearly 60,000 crore rupees. On the other hand, 30 mm naval guns are likely going to benefit BHEL and GRSC. Advanced lightweight torpedoes, they shall benefit BDL with an estimated impact of nearly 500 to 1,000 crore rupees. Now, EO IRST systems, they might benefit BEL, Astra Microwave, and Data Patterns alongside smart ammunition, which is likely going to benefit BHEL. So that's about the naval part of it. For the Indian Air Force, now CL, RTS or DS, they may benefit, the likes of HAL, which would add to its long-term order pipeline. Now, if you take a look at some of the stock-specific gains that could come in, it could be for BEL if the orders come through for GBMES, naval subsystems as well. Now, for BDL, it could be due to the Nag missile. BHEL could benefit due to naval guns, smart ammunition as well, and BEML, L&T and HAL, they could also benefit on the back of Air Force programs. Could be supply equipments, etc. All of these could benefit, players like HAL, L&T, BEML as well. Now, market activity, like I said, is picking up after a brief lull period. Year to date, defense stocks have shown strong gains. BDL is up more than 35%. Mazgaon Dock is up 25%. BEL 43%. BEML 8.5%. Whereas L&T, that has seen gains of about 6.9% this year. Now, with multi-year milestone-based orders that may come on the back of these DAC approval for procurement, now, these companies are expected to benefit from strong revenue visibility, keeping defense stocks in focus in the coming months ahead.
Okay, Kanishka, thanks so much for taking us through that. So yes, defense is a pocket of the market that everybody is focusing on today. We've spoken about defense at length in the morning. So in fact, let's shift that conversation slightly. And Kunal, give us your reading on Cummins India, a stock that's been soaring today, a 2.6% uptick. And Somal in the morning when we were chatting with him, he was bullish on the construct of the chart. Are you seeing similar optimism?
Yeah, I think it's a decent chart to look at. Over the last 3 quarters, the stock has done pretty well. This is the 3rd consecutive quarter of price uptrend for Cummins, and even on the daily charts, the volume in the last couple of days is on the higher side. So this indicates that potentially it's like a continuation move the stock has shown. After a brief lull period, the stock had shown for itself from the mid-September highs, which was, I think, closer to that 41.50, 41.60 mark for Cummins. So I think it's a decent chart. At current levels, indicates that the momentum is still on the upside and the trend still on the positive.
And what about the other big buzzer, and may not be exactly linked to defense, but it's Shipping Corporation of India. 8% higher in trade today. The only thing that came out in terms of fundamentals was that the board has agreed to the long-term business plan of Shipping Corporation of India. Outside of that, there's nothing much that should move the stock this much. And if you look at it from the start of the day, it was pretty much flat, and thereafter we saw a pickup in the stock. What are you observing in terms of a trend here?
In fact, this is the 2nd consecutive day for Shipping Corporation of India on the upside. I think yesterday also the stock was up some 6%, 5.5%, 6%. Today it's up 7.5%. Excellent volumes for the stock in the last couple of days. In fact, this was one of the stock which I had highlighted as one of the Diwali picks last week, where my targets from a medium term was closer to 275. the best part about the shipping corporation chart is that it's a weekly and a monthly time frame basis. It's an inverted head and shoulder pattern breakout, and that breakout potential for the stock is almost like a 40 to 50 pointer breakout, which translates to roughly around 15 to 20% for the stock price. So I think from that 225 levels, that the setup looks extremely attractive. This also potentially indicates that we are looking at a point where many of these so-called PSU names which have underperformed or just about remained into a negative territory for the last 2 or 3 years, these stocks can make a very strong comeback. Shipping corporation, I think on the shorter term chart still looks attractive. 275 is where I would believe that there could be some bit of resistance which may come into the stock.
Okay, so that's on shipping corporation. Kunal, Kotak Mahindra Bank, all of that is in, that stock is in focus today. It's down about 2% ahead of its earnings tomorrow. Help us understand on the charts, how does this stack up against an HDFC or an Axis, ICICI for instance, the top 4, the large banks, how do they stack up on the charts right now? We've got numbers for 3 of them on the fundamentals, Kotak of course tomorrow, but that stock is under slight pressure.
So relative price action wise, Axis Bank is still the strongest name. Kotak Bank stands out to be the number 2 in terms of price performance on a relative basis. HDFC Bank apparently is the third one, and I think in the last couple of days there has been a mild bit of correction from 1020 levels thereabouts to sub 1000 levels where the stock is trading right now for HDFC Bank. But the bigger underperformer from the private sector banking names and large cap stocks specifically is ICICI Bank. The stock had a get-go towards 1440 levels last week, but then the way the stock has sold off post the results indicates that we could be looking at the stock just about grinding for some more time over here. So as of now, it's Axis Bank which is amongst the top names, and Kotak Bank lands up to be the number 2 candidate in terms of price performance relative basis.
Okay, and all right, so that's the take on some of the private sector banks, and of course today in particular being a tough day where banks are concerned. But we'll continue this conversation further. We're going to have to slip into a very, very short break. On the other side, we'll continue talking stocks. Stay with us. Now, plenty of stocks flying around, and Kunal and me were just speaking about Sammaan Capital. That stock has really flown. Over the last month or so, the stock is up 40%, 45% in the last 6. From the bottom over the last 6, it's done 65% in terms of return. So that one doing very, very well. And it's obviously a 52-week high on the counter and also a 5-year high that the counter has seen, or rather since 2024. It's the highest level at which the counter now trades at. So something to keep in mind. We'll take a quick technical view. But before that, Colgate is the one which is under pressure. After reporting disappointing earnings, the numbers didn't exactly enthuse where the top line is concerned, but historical trends seem to show that this weakness has sustained for a few quarters. Market share loss, GST disruption, that's what's likely playing out, and it's painting a bleaker picture, if we can call it that. But what's been going wrong with its performance? Sneh takes us through Colgate's headwinds.
Well, yes, so the stock of Colgate-Palmolive is under pressure today on the back of weaker than expected Q2 numbers, although margins were able to sustain and they were in line with the street estimates. But other than that, overall weak set of numbers coming in. Brokerages have also maintained a negative stance. Some have downgraded the stock, and target price cut has been the theme across the board when it comes to brokerage reactions. But this is not the first time that Colgate's numbers have come out and the stock has been under pressure. This has been a trend that we've been seeing over the last 4 to 5 quarters. In fact, if I take you through what the divergence has been between what the street estimate was versus what the actual numbers were, you will see in a pattern across the top line EBITDA as well as the bottom line that this divergence only seems to widen with every quarter. Take for example the revenue number. In Q2 of FY25, the actual revenue was 1.5% lower than the street estimate, and now it's come all the way 7% lower than what the street was estimating in Q2 of this year, the most recent quarter gone by. Same has been the trend for EBITDA margin, wherein in Q1 it was 6.5% lower than the consensus estimates. Net profit too was 7.5% lower in Q1 and still continues to be about 6% lower for Q2 than what the street was expecting. So the divergence between the consensus estimates and what the actual numbers are, that only seems to be broadening, or it seems to be weakening. If you take a look at their margin trajectory, yes, in Q4 FY25 there was a spike in margins up to 34%. 34%. But other than that, margins have hovered around 30 and 31%. But remember, they have guided for margin guidance between 32 and 34%, and that is something that we haven't seen. Other than quarter 4, we haven't seen this in the last 5 quarters. In terms of volume trajectory, it's been a one-way road downhill. For quarter 2 FY25, what started at 8% came down to 4. Then in quarter 4 FY25, it became flat, and thereafter it has plunged into the negative territory, with quarter 1 FY26 at minus 3%, and this quarter analysts are pegging it could have been a minus 3 to 4% cut in their volumes as well. So if you take a look at the management commentary earlier in their analyst day and other meetings, they have said that market weakness will continue in the near term, and it's likely to play out in the second half as well. So some headwinds at play. If you take a look at their historical performance, this is the 3rd consecutive quarter where their revenue has fallen by more than 6% in a row. The inverted duty structure will not do them any good and will continue to weigh on their margins. Now, this company is at a structurally disadvantaged place when it comes to the entire GST rejig, because its entire portfolio is concentrated in one segment, which is oral care, and this space has seen a sharp decline in GST from 18% to 5%. So one-time shock coming in for their GST portfolio, it does not do anything to protect their margins. This is not the story when it comes to HUL and Dabur, because they have diversified segments, so they can balance out their margins over time. And if you take a look at the competitors in the oral care segment, HUL has reported muted oral care numbers, but Dabur's update showed some strong performance over there, which could indicate that Colgate has once again lost share when it comes to the oral care market. And lastly, if you take a look at the brokerages, yes, they continue to be negative. Some have downgraded, and the target price cuts is something that we've seen across the board. So all of these headwinds are at play for Colgate, and this is the reason why, along with its earnings, every time the numbers come out for Colgate, at least in the last 3 to 4 quarters, the stock has taken a little bit of a beating.
Okay, thank you for that, Snehi, for that roundup. And of course, along with it, same breath, HUL also not doing too well. Let's in fact take that question across to Ajay Bagga, market expert, here to speak with us with regard to fundamentals. Hi Ajay, always a pleasure speaking with you. Ajay, let me start off by understanding from you how you're viewing earnings and how you're viewing the market currently before I come to consumption. Do you believe that a strong earnings push led likely by consumption and capex is likely to come through maybe over the next 2 quarters or thereabouts, or are we seeing something which is slightly more longer drawn?
No, I think it's coming over the next 2 quarters, and this quarter will mark the bottoming out of downgrades. So we have got a shift by a quarter. We had expected that June would be it, but the Prime Minister's address on 15th August, and then the GST coming in, the GST cuts coming on September 22nd, saw a massive economy-wide postponement of expenditure. And that is what's coming through in the results of the durables and the staples manufacturers. So that has had an impact. So it will be a so-so earnings season for September, nothing very great. Financials are still recovering. The microfinance loans are more or less written off, but the unsecured loans still are a bit of a drag. So despite the leaders doing very well, you will see a very mediocre kind of results even on the financial side. But markets being forward discounting mechanisms, they are looking at what's coming for the December quarter and will there be a surge by the March quarter. I think that's looking very much online. And after 13 months of underperformance, we are setting up now for the markets to be in the catch-up mode.
Okay. Ajay, hold that thought. Actually, Ajay, give us a sense with regard to consumption as well, if you can. Give us a sense as to what you're seeing in terms of consumption trends, because when you're looking at a Nestle's numbers, when you're looking at a Colgate especially, which came out yesterday, and HUL, Nestle was obviously, there was some surprise in the numbers, but when you looked at Colgate, when you looked at HUL, the volume growth wasn't visible. Your sense with regard to the multiples at which some of these stocks are trading, and if there is an upside surprise to consumption as well, whether those multiples are warranted. That's point number one. And point number two, do you see a material upside with regard to growth on some of these names?
Yeah, see, multiples have always been high on the
Yes.
MNC, FMCG. So you really have to play it by the cycle. What has happened is the urban consumption has lagged. So urban demand has lagged while the rural demand has been quite strong, especially, with the food grains and all that expenditure taken over by the government for 80 crores of population. So there are systemic transfers happening at the bottom of the pyramid, but the middle bulge of the entire population has not seen wage growth of that magnitude as much as the inflation has risen over the COVID period and beyond. So that's what we are seeing playing out in the urban consumption. Rural consumption is strong, and all these players are largely in the urban and the semi-urban kind of space. They're not having a great footprint in the rural, which is more still on the unorganized players, unorganized retail and unorganized manufacturers. So volumes have been tepid. There is some bit of premiumization that's happening because given the economy was in a K-shaped recovery, so there has been some premiumization that has happened. But these players, especially the MNC, FMCG, have not justified the very high historical valuations that they have seen, and that's why they are largely underowned if you look at institutional portfolios. Going ahead, definitely there is a consumption boom post the GST cuts that we are seeing in autos, and then the entire auto ecosystem benefits from auto ancillaries to tire makers to various other suppliers into the autos. Those are doing well. Durables have done well, but they are coming off a very tepid summer, especially on the air conditioners, for example. So that's a catch-up trade. Staples, the valuation still not justifying a very big institutional play. So we'll have to wait for that. At least the growth has to catch up, and that will be a function of the urban demand. We need something more in the February budget in terms of a fiscal stimulus. RBI has done a monetary stimulus. Maybe they will give 25 basis points more. That's very welcome. Your EMIs go cheaper, that much money in people's pockets. GST cut, consumption tax cut has happened. That's very welcome. But overall, what is needed for the economy's aggregate demand to go up more on the urban side, and that gets, since the private capex is not coming, private wage growth is not coming, then the government has to step in and pump prime, and they have to do some more fiscal stimulus. They've done on the infra side that translates into the GDP eventually, but some more direct actions, hopefully, in February will be taken to stimulate the urban demand. So right now, very high valuations, not justified, and not very enthusiastic response from the institutional ownership of MNC FMCG.
We need to take a short break. On the other side, we'll continue this conversation and more. Of course, Kunal also waiting by. We'll ask him for some of his picks as well. Last half hour of trade to go. Stay with us.
About SBI Life, how all eyes are going to be on that Nifty 50 major, expected to report its numbers later today. But while we're talking about insurance, the government is set to push major reforms in the insurance sector this winter session in the parliament. Now, we learn from sources and ET Now learns the insurance amendment bill may include composite licenses, open architecture and even 100% FDI approval. Let's take it across to my colleague Anurag Shah for more exclusive details.
Much awaited insurance reform to be reality by year end, as government is all set to table Insurance Act Amendment Bill in upcoming winter session of the Parliament. So after the cabinet approval in upcoming winter session of Parliament, Insurance Act Amendment Bill will be tabled in Parliament, and composite license, open architecture and 100% FDI approval will be given under this bill. And which will be a very big reform in insurance sector, as government is moving ahead to achieve the target of insurance for all, and to make insurance sector attractive for foreign investors. These reforms are planned, and to increase the insurance penetration also. Previously there were reports that in Insurance Act amendment, composite license and open architecture may not be allowed, but as per our sources, government is moving ahead with composite license, which will allow to have a one license for life insurer business, for life insurance business, health insurance business, and general insurance business. So under the one roof, one license, these all type of insurance business can be done, and open architecture will allow insurance agent to tie up with a multiple insurance companies. So these reforms are planned for upcoming winter session.
Okay, thank you so much for that, Anurag. That's of course on insurance. Any insurance names on your list, Kunal?
Not much. I think the only one which is actually popping up on the charts is ICICI Lombard. That's the only stock which had, I think this week or last week, Friday, it had seen a very strong price action up move. Post that, 3-4 days of a correction / consolidation. So I think at current levels of 1980 thereabouts, it's a stock to look at purely as a contra buy. And if there is an anticipation of any kind of an uptick, I think most of the other stocks are still into an underperforming kind of a territory. ICICI Lombard looks to stand out from the entire pack.
Okay, so that's on ICICI Lombard. We also have Somil Mehta, who's joining us once again on the show. Somil Mehta, Head of Alternate Research at Mirae Asset Sharekhan. Somil, hi, good afternoon. We're talking about the insurance space right now. All eyes are, of course, going to be on SBI Life, but we're not expecting a very stellar set of numbers, of course, on the back of that GST impact that we've seen on insurance premiums now becoming absolutely zero. So other than that, on the technicals, Somil, anything that looks good from the insurance pack, or you're seeing some run up in some of these stocks?
I think ICICI Lombard, I definitely like ICICI Lombard, but other than that, LIC insurance, that one also looks good. A small triangle pattern is being forming above the 200 daily moving average, and I'll be expecting this triangle to break on the upside. So I'm positive on this stock, but I'll be waiting for a breakout above 907 levels. Once we break out about 907 levels, the next target for this stock would be around 935, and the next level would be 980. So these are the two levels I'm looking for, but I'll wait for a breakout about 907. But my top pick would be ICICI Lombard.
Pieces which will move over the next week or so. One will be the global geopolitical chessboard, which is unfolding at Malaysia, and this is now more of a macro question. And the second piece, of course, is on rates and inflation, both on US rates as well as inflation. What's the outlook like, and what do you believe the reaction on global as well as specifically Indian markets will likely be of all of this?
Is that for me?
Yes, please, Ajay. Yes.
No. So, US CPI expected at about 0.3% month on month on the headline, 0.4% core, and annualized numbers around 3.1%. Again, the numbers are delayed from October 15th was the date as per the BLS calendar when these numbers should have come out. So 24th day of the US shutdown means that we don't have any other data but this one, and this will be the last major data release before the Fed meeting of next week. More or less, it's a given that the Fed cuts based on the slowdown in the labor market. They will tend to overlook the inflation staying at that 3.1% handle. The second thing the market will watch out for is that what is the tariff inflationary impact flowing through. So far, it's not been passed on so much to the consumers, and the oil price falling has masked a lot of the price action. So we'll have to wait and watch that finally does the tariff impact come into the inflation numbers. Those will be the two things. One, does the number beat this market estimate of 3.1? Is it higher? Is it lower? Markets will move on that quite strongly because this is the only data point. And second will be any tariff impact that's visible. But more or less, it's a certainty as far as the Fed futures go. The markets are factoring in a rate cut, and the Fed will be going in blind apart from their own surveys. Whatever surveys the various Fed branches have done, that will be the only extra data they have. So they will go with the given point that the labor market is slowing down and better to cut rate now. And then we'll watch by December once the government is opened and clearer data is there with them. That seems to be the surmise.
Point taken. Kunal, Samman Capital, we did speak about this earlier and we did tell viewers we'll get your view on this one. What does this move mean?
This is a very strong breakout and a continuation move for Samman. We discussed this, I think, 2 or 3 weeks back when we spotted that first level of a breakout for Samman Capital. That time the stock was closer to 160, 164 kind of a range. Right now, we are looking at the stock hitting 187, 188 or northwards of that. So that's a very strong up move the stock has shown in the last 2 weeks. And today also, I think the volumes are on the much higher side for Samman Capital. And when you look at this in terms of price action, it's already trading at now almost a 16 or a 17-month high, breaking past about the March 2024 levels for the stock price. Of course, the stock has a lot of hard work to do when you try and compare this with the all-time high levels for Samman Capital. But even from a short-term angle, I believe that the stock could see further legs on the upside. I would place target ranges closer to 196 to 200 for the stock with the very near term.
Okay, so that's on Samman Capital. And the stock that Kunal was bullish in the morning was Vodafone Idea. Mr. Bagga, this stock is going to be in focus on Monday because we have another hearing that's due for their AGR plea in the Supreme Court. And this time the street is actually anticipating that instead of an adjournment, there could be an outcome, because of which the stock was very excited yesterday and continues to trade 1% higher today. Your take on this stock or the overall telecom sector, and who do you think has the right to win? Because Vodafone Idea is consolidating market share on one hand, and on the other you have Jio and Airtel that continue to do well for themselves.
Yeah, absolutely. I think it's a two-way street as far as telecom goes. So you have two players who are doing very well. Now, a government has brought in the 4G stack on the public sector company, which it has consolidated. So government is trying to up that company so that there is some amount of competition left in the market. A two-player telecom market for the size of India is not very good news. Overall, I think what has been shown is players that have taken early measures, like Bharti, for example, they actually raised money. They sold some stakes and raised money, and they were able to increase prices as well. So those have done much better. These very highly indebted ones, I would be careful of. Again, there is some noise that some Indian player might be stepping in. The government might give a memo to the Supreme Court that we are okay, given that the government is a big shareholder, we are okay with letting some of the dues go away. So all those we'll have to wait and watch. Again, Bihar elections time, frankly, I don't think the government will look for a judgment on Monday. Maybe they will try to postpone it by a month. But again, this Chief Justice retires on 23rd November. So various factors going in, not a very easy solution, very highly indebted company. Again, no buy or sell. I'm just telling about the sector. But I would be wary. I think always what has worked is go with the champions in a sector rather than look for turnaround stories. There are special situation funds and masters who are special situation masters who get it right. But for the rest of us, it's better to stay with the champions in the sector rather than look for turnaround stories.
So that's the take coming in on the telecom space, and continue to be with the champions. In fact, that is the take that we've heard from a lot of our market guests when it comes to the internet stocks as well, the platform companies, the likes of Zomato, Swiggy, and the verdict over there is also to continue to be with Zomato. So that's just a correlation that came to my mind. But yes, let's shift focus to SBI Life. Q2 numbers are out. Net profit has seen a 6.5% drop at 495 crores compared to 529 crores. That's the only metric we have as of now. Of course, we're awaiting the margin figure, the VNB, the APE. All of these are going to be important metrics to watch out for. The initial reaction, we did see a drop in the stock of about 1%, but seems to be recovering from there. It's just 0.5% lower right now. So that's the first tick of number that we're seeing coming in on SBI Life. Only the net profit number is out as of now. But Harsh, what do you think could happen to the stock, given that we've been talking about this entire GST angle on life insurance premiums? Now that's gone down to zero. Any major impact right now, or could that be seen in the next quarter?
No, likely the next quarter, because it's just been 8 days this quarter, or rather maybe for life insurance companies, maybe it was half a month of the quarter where GST rates had come off. So clearly out of the last 1.5 months, which was a washout, only half a month was where any sales would likely have been garnered. So it would be a soft quarter. But a low single digit growth is what we're expecting on APE, which is annualized premium equivalent. And of course, we'll have our eye on the margin number, which is expected to be around 27.2%. The net premium income number, obviously on your screen, 23% growth on that count. So we'll wait and watch. We'll still await the press release for that margin number. But let's talk a little bit also about earnings, because plenty of them anticipated. There's also Dr. Reddy's Labs all set to declare its numbers. And while the top line and bottom line are expected to see gains on a YOY basis, margins are seen to decline a wee bit. Srishti here with all of the expectations.
Well, it's expected to be a decent set for Dr. Reddy's, because this time around North America sales is expected to see a decline, because G-Revlimid price erosion is something that will be impacting the overall revenues, while the India business is expected to grow in double digits on a YOY basis. The Russia business is expected to be flat, and all these factors will be weighing in on the overall financials. Firstly, let's talk about revenue. That is expected at 8,703 crores this time around, and this will be a jump of 9% on a YOY basis. But the EBITDA is expected to be flat at 2,136 crores. Margins expected at 25% to be flat on a quarter-on-quarter basis, while in terms of the profitability, 1,399 crores is what we are expecting in, and that will be a jump of 4%. Now, in terms of the G-Revlimid, that is one of the key contributors in Dr. Reddy's numbers. That has come under higher price erosion, which means that the margins of this particular product are now lower than the previous years. The Russia business is expected to be flat due to the local business challenges. But in terms of the key commentary, we will definitely be watching out for the progress on the semaglutide approval for the Canadian market, their outlook on the in-house manufacturing capacity on the pens, and the approval with respect to some of the other upcoming key drugs from US FDA is something that we will be keenly watching out for.
We'll keep an eye out on that one. Somil, anything within pharma that you're liking, and DRL in particular, would you trade that?
Absolutely. Dr. Reddy looks great to me. Dr. Reddy has just broken out of a small consolidation last week and trading about 20 and 40 daily moving average. The entire consolidation was on 200 daily moving average, and I'll be expecting a good rally on the upside. Targets would be around 1325, and the next level would be 1350. So these are the two levels I'm looking for, and the stop loss would be around 200 daily moving average, which is 1254. So this is the entire short term targets. But in the medium term outlook, there's a huge triangle forming, and this triangle I'm expecting to break on the upside. So the targets would be much higher, above 1400 levels. So medium term targets are above 1400.
Okay, so bullish with regard to this one. I wonder what we should make of the move on the Nifty Bank, Kunal. You know, this little bit of weakness that we're seeing today, nearly 1% lower. What's the sense like?
After a 4,500 point rally, Harsh, this is the first day where you're seeing the Nifty Bank cooling off.
Sure.
I'll take it with a stride that the markets have done exceptionally well in the October series. And to give it to traders also, I think they're bound to take out some profits over here, maybe roll over positions to the next series, just try and juggle around with the mix in terms of the banking names. So within the banking names, that is, private sector banking stocks and the PSU banking names, as and how the results, etc., come out for these stock prices. But what we've seen so far is a very strong breakout for the Bank Nifty, breaking past above an all-time high level without the participation of names like ICICI Bank, Kotak Bank, and HDFC Bank coming to their lifetime high levels. I think that tells you that the Bank Nifty is now into the hands of many diverse stocks within the entire pack. That, I believe, is the hallmark for the entire banking index. That's why I would believe that the rally will sustain, even at the point where few of those large cap stocks would probably underperform for some more time. But when these stocks get their mojo back again, by that I mean the likes of ICICI Bank and HDFC Bank, etc. When these stocks get their mojo back, you might probably expect another 1,000 to 1,500 point rally for the entire Bank Nifty. So bullish on the entire prospect of the banking index over the near term. I expect that the last couple of days was just about a mere profit booking.
Okay, time to tell thanks to Somil as well as Ajay for joining us this afternoon, giving us all of those views. We'll let you go, gentlemen. Kunal, stay with us. We'll go across to Snehi for the market close.
Well, yes, let's take a look at how the markets have panned out in today's trade. In similar moves to yesterday, started on a good footing but fizzled out entirely by the day's end, and that's something that we've seen today as well for the market. If you take a look at what the market performance has been today, a 0.4% cut coming in, but yes, below 25,800 as well. In fact, today was a day where we were hoping to cross that 26,000 mark on the Nifty and stay there. At least that was the gift Nifty was implying in the morning, but it's been an entire turn of events. A similar move for Sensex as well. Bank Nifty also continues to be under pressure. The broader end of the market has also not done very well for itself, but at least nominally better than what the benchmarks have done. It's names like Hindalco, Bharti Airtel, ICICI Bank, Shriram Finance, BEL. These are some of your top Nifty gainers. On the flip side, some pressure continues from Cipla, HUL, Ultratech, Apollo, Adani Enterprises. So it's aluminum stocks, the metals, they have been a winner through and through today. On the flip side, some pressure coming in for PSU banks, FMCG stocks. Of course, we take a look at Colgate, take a look at HUL and how they have put pressure on some of the other FMCG stocks as well. And that has been the top sectoral laggard, followed by Nifty PSU Bank, Nifty Bank, Pharma, Auto, Media, IT. These are all your sectors in the green. So only metal, realty, and to some extent, energy has done well today. So that is how we're wrapping it up. Some stocks like Shipping Corporation, Saman Capital, they have done exceedingly well for themselves, as has been the case with some defense stocks. But Harsh, back to you for final closing comments.
Flat a move on Federal Bank. That was the big one, mind you, today. Thank you for that, Snehi. Absolutely flat. And this is a 6,200 crore fundraise, so it's a large one. But despite that, the stock just hasn't moved, it seems. And has, in fact, moved at the start of the day, but cooled off. And we've closed ever so flat on that one. So that one also in focus. I wonder what are some of the textile stocks done today. Let's pull up Gokaldas Exports, Wellspun, Living and the like, and try and get a sense of what those stocks have done. And there you go, 1% or thereabouts. Saw a bit of a spike at the end on another 4% on Gokaldas. So yeah, so I mean, those stocks also made a bit of a comeback, those couple of stocks with regard to textiles. Kunal, how do you play the taco trade?
That's the most difficult part to anticipate. Every Friday, except for that previous Friday, we've had some sort of a shocker for the markets. Let's just hope that we have a normal Friday yet again this time around. But yeah, I think if Trump again chickens out, then I think that could be positive for the entire scenario, because crude has run up or shot up $5-6 in the last couple of days. So maybe if that ebbs off, that immediate pressure which you're seeing on the markets, that also cools off.
Okay, and also you'll have Kotak Bank, which will come out with numbers tomorrow. So lots to anticipate, but we'll see you on Monday. We're closing for the day today, and of course, continued coverage on ET now will take all of the action forward. Stay with us.